Hello, this is Sandra Cho with Pointwealth Capital Management, and today I'm going to be going over October month in review. In October, stock and bond returns were Halloween horrible. The S&P 500 and NASDAQ were both down over 2%, and the Dow was down 1.26%. Both EFA and emerging international stock markets were down about 4% for the month. Bonds were down over 1.5%. Year to date, as of October, the S&P 500 is up 9.33%. But if you exclude the largest 10 stocks, the market was actually down 8.86%. The 10-year Treasury is close to 5% now, which is a 16-year high. On a practical level, that means that interest rates on mortgages, car loans, and credit cards are high. It also means that you're finally getting paid to be in treasuries, corporate and municipal bonds, CDs, and money markets. Historically, when interest rates get to 5%, it also means stock market volatility. Investors start to ask themselves, why take the risk of stocks when you can get 5% virtually risk-free? And they start pulling money out of stocks. Just remember, historically, stock returns are higher than 5% per year in the long term, so make sure to stay diversified and invested. Now for the good news. The last 2 days of October saw the S&P 500 and NASDAQ up over 1.5%. Winter is coming, and that's not usually a bad thing. November has historically been the best performing month of the year for stocks. The Fed's previous 11 rate hikes have seemed to work, and September inflation numbers were down 3.7% compared to a year prior. Quarter 3 GDP numbers also came in October and showed a stronger than expected 4.9% annual rate, boosted from strong consumer spending, especially in travel and entertainment. However, when you look at the main things people are spending money on, it's housing and utilities due to increasing costs. We are seeing consumers spending down their savings. What does the rest of the year hold? Market experts predict quarter 4 GDP growth to be weak as consumers become more frugal and their savings decline. There remains one more Fed meeting for 2023, which is mid-December. Their decision on whether they increase rates will be driven by the economic data as it comes in. If they hold rates, I expect the market will happily react and go up for the short term. Despite the negative headline news regarding big tech's earnings, the earnings season has actually been quite strong. Earnings per share are up 4% year over year, and 77% of companies reporting have beat their expected earnings. The first student loan payments were due at the end of October. Many experts do not expect the restarting of loan payments to have a significant impact on consumer spending or the economy overall. Finally, who can talk about October without talking about the Middle East? The Hamas attacks on October 7 have caused immense sorrow. Escalation of the wars in Ukraine and the Middle East could lead to additional market volatility. Being informed is great, but how does that help you or your investments? For one, it's good to know how investments react in different environments. When interest rates are high, stock and bonds tend to become more correlated, which means that they tend to move up and down closer together than normal. Alternative investments such as market neutral strategies can diversify your portfolio. Likewise, if you are worried about a recession, you might want to reduce your exposure to sectors such as energy and automakers and increase your holdings in utilities and healthcare. Regardless of what you think is going to happen in the future, it's always good to talk with a financial advisor to get professional advice and weatherproof your portfolio for potential rainy days ahead. Thank you so much, and I look forward to seeing you in November on Pointwealth Perspectives.